In today's session on cost accounting, we explore key cost allocation methods. Beginning with plant-wide costing and progressing towards activity-based costing, we set the stage for understanding the approaches that determine product costs. We begin by examining a common problem: how to fairly allocate indirect costs across products. Traditional costing uses simple averages. Imagine a bakery that makes both plain bread and elaborate wedding cakes. If you divide total overhead, rent, equipment, utilities, equally based on, say, labor hours, you might conclude both products cost similar amounts to produce. But that's misleading. The wedding cake requires specialty equipment, more quality checks, custom design time, and careful packaging. Plain bread just rolls through the process. Traditional costing would undercost the wedding cake and overcost the bread, leading to bad pricing decisions. Next, consider the spectrum of cost allocation approaches. On one end, plant-wide costing is simple yet imprecise. You dump all factory overhead into one big pool and spread it across products using a single allocation base. This assumes all products consume overhead in the same proportion to machine hours. A hand-carved piece that requires extensive quality inspection, special handling, and custom finishing gets the same overhead rate as mass-produced items. The simple products subsidize the complex ones. Department allocation offers a balanced solution. You recognize that different departments have different cost structures, so you create separate overhead pools for each. However, within each department, you're still averaging. Two products in finishing get the same rate per square foot, even if one requires hand rubbing and the other just gets a spray coat. Activity-based costing, though complex, delivers improved accuracy. Instead of pooling by location, plant-wide or department, you pool by activity, the actual tasks that consume resources. This gradient illustrates the trade-off between simplicity and precision. The progression from plant-wide to department to ABC is really about one thing: finding allocation bases that better reflect causation. Plant-wide says machine hours cause all overhead. Department says different things cause overhead in different places. ABC says specific activities cause specific costs, and we should trace them precisely. Each step adds accuracy, but also complexity. The right choice depends on whether that extra accuracy is worth the cost of obtaining it. Focusing on the plant-wide approach, all overhead costs are pooled and divided by total machine hours. For example, a furniture factory has 500,000 pounds in total overhead and expects 100,000 machine hours. Every product gets charged £5 per machine hour, whether it's a simple stool or an intricate hand-carved armoire. This method, while straightforward, may oversimplify cost behavior. Consider its limitations. Turning to the departmental approach, same furniture factory, but now split into 3 departments. Costs are allocated based on distinct departmental activities. Different departments have varied cost structures, so products using expensive departments incur higher charges. A product moving through all 3 gets charged based on how much it uses each department. The armoire that spends lots of time in finishing gets charged more there. The stool that's mostly machined gets charged more in machining. Now we explore activity-based costing, which allocates overhead costs by tracing activities in detail. For instance, costs for spray coating, hand rubbing, inspection, and color mixing are assigned based on actual usage. This method improves cost accuracy by linking expenses to tasks, boosting efficiency. Consider a practical ABC example comparing finishing costs. Within that finishing department, ABC would identify distinct activities. Now the armoire that requires hand rubbing, multiple inspections, and custom color gets charged for what it actually consumes. The stool that just gets a standard spray coat pays only for that. A simple stool, with minimal finishing steps, costs only £17, while a custom armoire incurs £247 due to more detailed activities. This 14.5 times difference highlights the precision of activity-based costing. Such disparities underscore real resource consumption. Finally, we compare when to use each costing method. Plant-wide costing suits uniform products, Departmental costing balances diversity, and activity-based costing works best for complex, variable items. These guidelines help determine the most fitting approach for any business scenario. Understanding the evolution of cost allocation is key. Initially, plant-wide costing assumes one overhead cause. Then, departmental costing recognizes varied causes by department. Finally, ABC costing assigns costs based on specific activities, emphasizing causation. This progression leads to more accurate cost management decisions, reinforcing sound decisions. Costing methods present clear trade-offs. Plant-wide is simple but imprecise, departmental improves accuracy with moderate effort, and ABC offers high precision at increased complexity. This comparative table encourages us to weigh cost pools, data requirements, and implementation expense to choose an appropriate costing strategy. Summarizing our journey, choose a costing method that balances accuracy with effort. Plant-wide is quick, departmental offers moderate refinement, and ABC delivers precision for complex operations. This summary underscores that method selection directly impacts cost clarity and operational efficiency, strengthening your well-informed financial choices. Refining a costing system requires careful assessment. Consider direct cost tracing, cost pool homogeneity, cost-benefit tests, and behavioral impact. These guidelines help determine when enhanced costing methods are justified. Ultimately ask, are product costs significantly different enough to warrant a refined approach for success? Recognizing the signs of an outdated costing system is crucial. Red flags include imprecise allocation bases and mismatches in cost reporting, while symptoms such as pricing problems and product mix confusion indicate the need for refinement. Other red flags include winning bids you expected to lose, suggesting some products are undercosted, losing bids on simple high-volume products to competitors, profits that don't improve when you sell more of your most profitable products, and using a single overhead rate or direct labor as the only allocation base when operations have become diverse or automated. If the cost system hasn't changed in years despite major operational changes, it's likely time to evaluate and refine. Cost hierarchies reveal how costs accumulate at different levels. This slide introduces unit, batch, product, and facility costs, each represented by distinct colored circles. Understanding these levels enables better cost allocation decisions and improves managerial insights into operational efficiency, driving smarter business strategies overall. Without understanding hierarchies, you might lump all indirect costs into one pool and allocate by machine hours. This treats setup costs batch level, the same as machine energy unit level, which distorts product costs. With hierarchy understanding, you create separate pools for each level. This is exactly what ABC does. It uses the hierarchy to ensure each pool contains costs driven by the same factor, which is the homogeneity principle from step 3. The batch size example illustrates why this matters. A setup cost doesn't change whether you produce 10 or 100 units in that batch. If you allocate setup costs using machine hours, a unit-level base, you're pretending setup costs increase with each unit produced, which isn't true. Small batch products get undercosted and large batch products get overcosted. So cost hierarchies are essentially a framework for designing homogeneous cost pools with appropriate allocation bases. Exploring the 4 levels of cost hierarchy, this slide details unit, batch, product, and facility costs. Each level is explained using clear examples. The key takeaway emphasizes matching allocation bases to cost behavior, ensuring methods align with actual cost incurrence, driving improved financial decisions. This slide illustrates a furniture factory's cost hierarchy with facility, product, batch, and unit costs. It explains how batch setup costs affect unit pricing, showing that larger batches lower the per unit expense while small batches drive up costs, revealing limitations in traditional cost methods. This table clearly aligns cost allocation bases with cost hierarchy levels. Notice the color-coded rows distinguishing unit, batch, product, and facility levels. The warning reminds us that using volume bases for facility-level costs may create significant distortions in cost analysis. Focus on precision care. How to determine the correct denominator for overhead rates. Compare the 100,000 unit capacity with 80,000 units produced, prompting the question: should our calculations be based on full capacity or actual production levels? Consider both carefully when choosing. This slide illustrates 4 capacity concepts through a segmented bar and description boxes. It details theoretical, practical, normal, and actual capacities with respective values. Theoretical capacity represents the maximum possible output under perfect conditions with no downtime, 100% utilization, rarely used as it's unattainable. Practical capacity adjusts for realistic factors like maintenance, setup time, and breaks, representing the maximum achievable output. Normal capacity is the average expected output over several years, smoothing out seasonal and cyclical fluctuations. This is the gap-preferred method for allocating fixed overhead to inventory, because it prevents product costs from being distorted by abnormal production levels. Actual capacity is simply what was produced during the current period, used primarily for variance analysis. The choice of capacity level directly impacts the fixed overhead rate per unit. The higher the denominator, capacity, the lower the cost per unit, which affects inventory valuation, gross margin, and pricing decisions. This analysis shows how fixed overhead and variable costs interact across different capacity scenarios. It compares theoretical, practical, normal, and actual capacities, illustrating rising unit costs, with the actual scenario emphasized to display a striking 38% cost difference. Understanding cost shifts drives decisions clearly. This slide addresses the unused capacity problem, illustrating a cost-death spiral. The unused capacity problem occurs when fixed overhead is allocated using actual production volume, causing per-unit costs to rise artificially during low-demand periods. Even though the underlying fixed costs haven't changed, this can trigger a cost-death spiral. As demand drops, fewer units absorb fixed costs, inflating unit costs. Managers respond by raising prices to protect margins, which drives away more customers, further reducing volume, further increasing unit costs, and so on until the business prices itself out of the market entirely. The solution is to use normal or practical capacity for overhead allocation, which keeps product costs stable and separately identifies idle capacity costs as a management issue rather than hiding them in inflated product costs. Notice the highlighted recommendation for practical capacity, emphasizing internal decision-making. Normal capacity is required for inventory reporting under IS2 and ASC 330. However, you don't maintain separate books. You simply use practical capacity for management decisions throughout the period and make a straightforward adjustment entry at period end by debiting cost of goods sold, or a variance account, and crediting inventory for the difference between overhead applied using practical capacity versus normal capacity, effectively expensing the idle capacity costs that GAAP does not permit to be capitalized into inventory. In Part 4 of our presentation, we review the 6-step framework for designing a costing system. Colored icons and sequential steps integrate allocation methods, cost hierarchies, and capacity analysis into a systematic approach, ensuring comprehensive cost management design. This infographic outlines a 6-step costing system design process. Designing a costing system involves 1. Identifying the cost object, what you're costing, product, service, customer, project. 2. Identifying direct costs that can be traced economically to the cost object. 3. Selecting cost allocation bases, cost drivers, for assigning indirect costs. 4. Identifying and accumulating indirect costs into cost pools. 5. Computing the allocation rate for each cost pool, pool divided by allocation base. And 6. Applying indirect costs to the cost object by multiplying the rate by actual usage of the allocation base. In this first step, identify the cost objects by defining what each represents in your process. A cost object is anything for which measurement is desired. Ask key questions regarding decision influence, detail, and users, and consider products, services, customers, projects, departments, and channels. Second step, distinguish between direct and indirect costs. Direct costs can be traced to a cost object through cause and effect relationships, whereas indirect costs require allocation. Consider examples from furniture manufacturing, where materials and labor are direct, and overhead such as rent or depreciation is indirect. Third step, select the cost pools by grouping individual indirect costs that share a common driver. Understand that method choice influences the number of pools, progressing from one plant-wide pool to several departmental or numerous activity-based cost pools, ensuring homogeneity in cost behavior for accuracy. If you use ABC costing, you need to consider the cost hierarchy and create separate pools for each level. Ensure each pool contains costs driven by the same factor, which is the homogeneity principle. Fourth step, choose the appropriate allocation bases by identifying cost drivers that justify cost distribution. Ensure your bases adhere to criteria such as cause and effect, fairness, and practicality, while matching cost objects' hierarchy levels, from unit and batch to product and facility, thus optimizing cost allocation efficiency significantly. Now compute allocation rates using the formula. Cost pool total divided by allocation base quantity. Compare budgeted rates with actual rates, and note that capacity choices impact stability. You should use practical or normal capacity. Finally, allocate costs to cost objects using the formula. Allocated cost equals rate multiplied by base used. Follow through with a real example, such as a custom cabinet batch, balancing direct materials, labor, overheads, and engineering allocation to determine the final product cost accurately. Observe how allocation methods, cost hierarchies, and capacity analysis interrelate to inform decision-making steps. Each colored box symbolizes a distinct concept that connects to specific design actions, ensuring a process that comprehensively aligns strategic cost allocation with practical capacity considerations, thereby ensuring complete clarity. In this final framework, integrate a 6-step process with allocation methods, cost hierarchies, and capacity choice. Emphasize decision-useful information over perfect accuracy, using visual cues from colored boxes and progress indicators to design effective costing systems that support informed pricing and strategic improvements consistently.